How to make money in real estate. Lecture 8. Risk of investing in real estate. Investing in real estate has been one of the best ways to build long-term wealth. The fact that investors buy physical properties gives them a level of comfort. However, just as with any other type of investment, real estate investing also entails certain risks, which you must be aware of. Like with any other form of investment, something could possibly go wrong with rental property investment as well. You must do your due diligence before stepping in, which includes property inspection, location characteristics, maintenance expenses, property taxes, property protection. The objective of rental property investing is to yield significant return on investment in a relentless way, and also mitigating the risks associated with owning a rental property, which are general market risk, liquidity risk, income risk, negative cash flow, choosing the right location, high vacancy rates, problem with tenants, replacement cost risk. General market risk. All markets have ups and downs tied to the economy, interest rates, inflation, or other market trends. Many investors wrongly believed the real estate market could only move in up direction. The basic assumption was that if you bought a property today, you could sell it for a lot more later on. While real estate values do tend to rise over time, the real estate market is unpredictable, and your investment could depreciate. Supply and demand, the economy, demographics, interest rates, government policies, and unforeseen events all play a role in real estate trends, including prices and rental rates. Liquidity risk. Taking into consideration the depth of the market and how one will exit the investment needs to be considered before buying. However, a property located in rural area will not have nearly the same number of market participants, making it easy to get into the investment, but difficult to get out. If you own stocks, it is easy to sell them if you need money or just want to cash out. That is not usually the case with real estate investments. Because of the lack of liquidity, you could end up selling below market or at a loss if you need to unload your property quickly. Real estate is considered a low liquidity investment, meaning that money invested in real estate is usually tied up for a considerable period of time. Income risk. Many people invest in real estate because of the consistent income it provides. But there is always a degree of risk in that income stream, where the landlord is taking on the tenant credit risk, which could lead to gaps in cash flows from unforeseen downtime, or vacancy. The length and stability of the property's income stream is important. For example, a property leased to Apple for 30 years will command a much higher price than a multi-tenant office building with similar rents. However, keep in mind that even the most creditworthy tenants can go bankrupt, as history has shown us time and time again. The more stability in a property's income stream, the more investors are willing to pay. Furthermore, new construction may seem like a better bargain than a 30-year-old structure customized by a prior tenant. Negative cash flow. Cash flow on a real estate investment is the money that is left after paying all expenses, taxes, and mortgage payments. Negative cash flow happens when the money coming in is less than the money going out, meaning you are losing money. The best way to reduce the risk of negative cash flow is to do your homework before buying. Take the time to accurately and realistically calculate your anticipated income and expenses to make sure the property is in a good location and has the potential to generate positive cash flow. Choosing the right location. Location, location, location is a common mantra in real estate. But most people have no idea what it really means. Location drives the factors that determine your ability to make a profit. The demand for rental properties, types of properties that are in the highest demand, rental rates, and the potential for appreciation. In general, the best location is the one that will generate the highest return on investment. You must do some research to find the best locations. Things to research about location. It is a good idea to research the market trends and zoning in the area you are targeting. What has been the property appreciation rate over the past few years? What changes, if any, are being planned by the zoning board? Additionally, you will want to study the neighborhood. Survey the shopping amenities. Drive around during rush hour to assess traffic congestion. Look into the crime rate trends and check out the ratings of the school system. These factors matter to anyone who may want to rent or buy the property. High vacancy rates. Whether you own a single-family house or an office building, you need to fill those units with tenants to generate rental income. Unfortunately, there is always the risk of a high vacancy rate in real estate investing. High vacancies are especially risky if you count on rental income to pay for the property mortgage, insurance, property taxes, maintenance, and the like. The primary way to avoid the risk of high vacancy rates is to buy an investment property with high demand, in a good location. You can also lower your vacancy risk if you price your rental rates within the market range for the area. List your property with a real estate professional. Advertise, market, and promote your property, being mindful of where your target tenant might look for property information. Choose traditional methods or advertise online. Start looking for new tenants as soon as a current one gives notice they are moving out. Make sure your property is clean, tidy, and well maintained. Develop a reputation for being nice and renting quality properties. Think Airbnb reviews. Offer incentives and rewards to keep tenants happy. Problem with tenants. A bad tenant can end up being more of a financial drain and a headache than having no tenant at all. Common problems with tenants include those who do not pay on time, or do not pay at all, which could lead to a lengthy, costly eviction process. Trash the property. Do not report maintenance issues until it is too late. Host extra roommates, human or animals. Ignore their tenant responsibilities. It is essential to place tenants who pay the rent consistently, respect you, and take care of your property. While it is impossible to eliminate the risk of having a problem tenant, you can protect yourself by implementing a thorough tenant screening process. Be sure to verifying their employment. Make sure they have a steady salary that can reasonably cover rent and living expenses. Run a credit check and criminal background check on every applicant. Also, contact each applicant's previous landlords to look for red flags like late payments, property damage, and evictions. Be sure you and your investment properties are adequately insured against losses and liability. Replacement cost risk. If a 20 or more year old apartment building can lease apartments at a rate that would justify new construction, but in the case that competition may come along in the form of newly built offerings, it may not be possible to raise rents or maintain occupancy in the older building. Hidden structural problems. One sure way to lose money on an investment is to underestimate the costs of repairs and maintenance. In the purchase process, it is far too easy to buy a property that is more damaged than it looks. Thankfully, you can lower this risk if you thoroughly inspect the property before you buy it. If a problem is discovered, find out how much it will cost to fix and either work that cost into your deal or walk away if it would prevent you from making a reasonable profit. You must calculate costs with diligence and take some leaps of faith. That means there is a risk that you are not getting what you think you're paying for. This increases the chances of facing unexpected renovations, repairs, and maintenance costs. Becoming over-leveraged. Most real estate investors use leverage to buy and hold properties. For investment properties, lenders typically require a 20% down payment. So, you can pull out 80% of the new appraised value in cash. You are then leveraged 80% on the property. Do this over and over again. and you end up with a lot of leverage risk. As a general rule, the more debt you have on an investment, the riskier it is. And as with any investment, you should expect a higher return for taking a higher risk. Use leverage very sparingly. I know it is as easy to become over-leveraged in real estate as it is to abuse a consumer credit card. Be sure you are receiving an excellent return to compensate you for the risk, whatever your risk tolerance may be. Here is a good rule of thumb. Leverage should not exceed 75% of the asset value. The bottom line. If the above factors are not well understood and managed, real estate becomes a risky investment. And because investing in real estate involves putting a significant amount of money at stake, the losses can hurt. Real estate has traditionally been considered a sound investment, and investors can enjoy a passive income, excellent returns, tax advantages, diversification, and the opportunity to build wealth. Just as with other types of investments, however, real estate investing can be risky. You cannot instantly sell a house to pay for sudden and unexpected expenses. Real estate investing also requires a significant amount of money. You can limit your risks by doing your due diligence and conducting a thorough real estate market and rental property analysis. Also, be sure to hire pros to inspect the property, screen potential tenants, and learn everything you can about the real estate market. Thank you for watching the video. If you watch all my lectures, you may be able to start investing in rental properties a little quicker. Please subscribe to my channel and press the bell to get alerts when a new video is posted. Please write your comments, questions, or concerns you would like to share.